Everybody, just one more reminder. We got a couple more minutes, and then we're going to go ahead and get started with our show. Please go ahead and get a seat where you can see everything, and yeah, get ready. Okay, hello and welcome everybody to TEN's inaugural pitch event of the year. We're really excited to have y'all, and we have 7 amazing companies for everybody today. I'm going to start by just handing the mic off to our CEO, Hall Martin, to tell you a little bit more about TEN before we get started. So Hall, why don't you come up here and talk to the good people.
Thanks, Shane. Well, thank you, everybody, for joining us here today. It's been 4 years since we actually did in-person events. We actually started TEN Capital back in 2009 and have been working ever since. And up until just before the pandemic, we would actually do 31 events around the country. It was a lot of fun, but we also did them by ourselves. And this time we're doing them with a lot of our partners. So we actually are having a number of cities that we'll be going to around the country as well. One rule I had in going around the country is that in the summer, we're going to be in the north, and in the winter, we're going to be in the south. And don't ask me to go to Boston in December, and don't ask me to go to Houston in July. We're going to swap those things around. So we've learned how to do that. But I want to thank you guys for joining us today. It's great to see so many faces I've seen before and see them back here in action with us today. Appreciate you guys coming out. And so I want to introduce this new series we have called TEN Capital Live. That means we're in person. It's also a hybrid event. It's online as well. A lot of people are zooming in, listening to what we're doing right now. And we came up with the idea of calling it the funding funnel because just like there's a sales funnel where you're driving customers through your process, so there's the funding funnel where you're trying to drive investors through your fundraise as well. And that's what TEN Capital does. We help companies connect with investors. We help investors connect with companies. And the other thing we do is we form capital. We help angel groups find members. We help VC funds find limited partners through primarily family offices. We have family office panels, but we do that. And we're also bringing more angel groups to Texas. We're actually bringing a Keiretsu forum here to the Texas region. It's the last big state in the country that does not have a Keiretsu. In fact, Keiretsu is the #2 Texas is the #2 state for Keiretsu-funded deals, but there was no Keiretsu here. They all went to other states to do that. So there's a lot of startups that are going to benefit from this and a lot of investors that are going to benefit from that as well. So we're forming capital. We're helping more people come and raise funding for their startup here in Texas as well. So with that, I want to thank you guys for coming out and looking forward to catching up with you in the happy hours as well. Got 7 great deals up here for you to look at today, and then we'll have discussions with you afterwards. With that, I'd like to introduce our investor panel. I'd like to go ahead and start off with Leanne, if you can, and tell us more about yourself and introduce your group to the audience. Should I just stand up and...
Hi, I'm Leanne Yang. I'm with the Horned Frog Investment Network out of TCU, so I'm a program director for the Institute for Entrepreneurship and Innovation there.
Thank you. Well, that was quick. That's great. Good. Wasn't expecting that quick. So Ed Pierce, I'm from Dallas, along with Tamano and Doug. We're with the Lions Den. So the Lions Den basically connects startup companies with investors. We have a large investor network, and we get companies funded. Really has a faith-based element to it. So for-profit companies where we want to know what you're doing for God's kingdom. And so that's a great venue to have people come together and really just have a great amount of synergy and networking. And so we've known Hall and the group for several years, and we're happy to continue that relationship. So looking forward to today.
I'm Gary Forney. I'm chairperson for the Central Texas Angel Network, CTAN for short. We're the local angel organization. We put together roughly 125 million in deals, over 200 companies over the last 16, 17 years we've been in existence. We're broad-based generalist investors across the board. So if you have a startup in Central Texas, not just Austin, please come, please apply to us, centraltexasangelnetwork.com.
Hi, everyone. I'm Jia Li. I'm with Oak Sea Ventures. We focus on cybersecurity investing. I've been in Austin for over 10 years now, so I wanted to boast that I'm a long timer. However, just realized that so many of you beat me, but don't feel bad if you've only been here for a little while, and welcome to Austin, and thank you, Hall, for building the entrepreneurial ecosystem here. Really appreciate it, and look forward to meeting all of you. Thanks.
Thank you guys for joining us here today. With that, I'll pass it back over to Shane, who will talk about our program.
Great. Yeah. So today we do have 7 great companies, as Hall mentioned. I do want to get into it pretty quickly here just because we are a little bit on a tight schedule. If you do have any questions outside of our panel of judges, please either write them down if we don't get to them, because we will have time in the networking portion after this where you can go up and ask your questions. Or if we do have time, we might, go out and pass the mic around. With that, I'm going to bring up our first company. Not sure where he's at the moment, but Brookwood, come on up here and get us started whenever you're ready. And also, yeah, stick around. We will have happy hour after this. I know you guys are dying for some good eats and good drinks, so we'll get to that as soon as we can, I promise. But with that, I'm going to pass it off once we get the presentation going.
Go to the next slide. Next slide. I think the latest statistics coming out of the University of Michigan was that, close to 25% of the population of Michigan is going to be over the age of 60 by 2030, which is not that far off.
And historically, they're down their homes in order to leave the state. That's not happening anymore. So we said, okay, a great opportunity to really not just, to make money, but at the end of the day, you're really doing something great for the state, great for the community, and you're giving back. We call it garden style ranches, means they're private entrances, private, they're not sharing areas except the community center. It's beautiful. So it gives them the ability of being a completely smart enabled, green friendly home, 1,240 square feet, beautiful community, nature trails, dog parks, community center, that's affordable.
And it's been very well received.
And by doing all that, we didn't forget also our investors. It's going to be highly profitable because of the simple fact that there's not a lot of competition.
And we control every aspect of it. The construction is part of the Brookwood team. The major consultants are hired by the Brookwood team, and we're pinching every penny.
We're super excited about what's yet to come, genuinely helping our state and our communities and hopefully our country.
And I'm dedicated to it, and I know that this thing is going to work out. I know this thing is going to. Well, hello, everybody. Thank you for sitting through that. We thought that's a good overview instead of me talking. I just wanted to make sure I wasn't wearing the same jacket as the video, because that would be kind of awkward. But we're not a high-tech company. We are a real estate development firm out of Michigan and Brookwood Senior Living. We are currently developing 4 projects. We're here to introduce to you our Regulation A raise of Brookwood Fenton. It's a 224-unit development just outside of Detroit. I'm going to jump in, and I'm here with Danny Baydoun, who is our Director of Investor Relations. And I'm going to go through our presentation pretty quickly because we don't have a lot of time. Danny's going to talk about some numbers, and we'll be glad to answer any questions and then meet with you guys later to talk about this exciting investment opportunity. I really went over the executive summary just now, where we're at. So we've been we've been doing development for a little over 4 years. We have 4 projects right now. Right now it's about 600 doors. We have on the slate to do another 3 projects in the next 2 years to get the total count up to about 1,000 doors. The leadership team, next slide. You know, you hear this a lot about people being a certain business. We have a combined staff or leadership team that has over 80 years of experience in real estate. And I don't, take that seriously because most of us are over 60 or 55. So we've been doing this for a very long time. We currently oversee somewhere around $240 million in investment funds for our clients, and that's across the spectrum of single family residence portfolios, and also in the senior development. The next slide. How we differ. We put everything under the Brookwood umbrella. So from the acquisition team to the group that goes out and gets the approvals from the cities, and the construction, the management, everything is under the Brookwood umbrella. That allows us total control of this project from start to finish and then ongoing. What we're offering here with the Brookwood Fenton Regulation A+ raise is the ability for investors to come in at the development level and then get that high return when we exit in 3 to 5 years. Next slide. So why are we doing this? And it's all about the market opportunity. So you've seen this before. Everybody, I'm sure, I could say raise your hand, but we all know that we're all getting older. And the population is getting older, and the demand for senior active lifestyle living is growing. And why Michigan? Because thankfully, well, I've been a Michigander for my whole life, but we're not seeing a whole lot of Michiganders leave doing the snowbird trek down to Florida, down to Arizona, because it's too expensive, and they want to stay closer to their families. So what we identified through our vast experience in real estate in the market about 5 years ago is there hasn't been a lot of new construction builds in the active senior communities, and we identified the population growth that is happening. And like I said in the video, this is actually a study out of University of Michigan. In Michigan, the number is 23% of the population in the state of Michigan will be over the age of 60 by 2030. And that's a huge demographics that we're putting ourselves in front of. Next slide. This just reinforces what I just said on the senior and the living market trends. And this is from different studies from all over the country, but it's the same in Michigan, it's the same in Midwest, it's everywhere. There's demographics of this opportunity are very, very strong. Next slide. And this is our primary development. It's a little overview on Brookwood Fenton. It's right outside of Detroit area. It's northwest of Detroit. It's in a very quaint area surrounded by lakes. It's a rolling development, has nice topographical area, the hills, and it's in a nice community, medicals, shopping, everything is there to support this project. Hopefully, I just decided that you might not be able to hear me. Does everybody hear me okay? Okay, thanks. Next slide. So as an investor, we're going to get down to the nitty-gritty here in regards to return of expectations and the project phase timelines. This is not a pipe dream investment opportunity. It's shovel-ready, meaning that we have full approval from the township, from the city, from the county, and we've actually started infrastructure development. We've done all the land balancing, all the grading, and we started laying pipe for the water and sewer systems. We had to stop because it snows in Michigan and it gets cold, so we have everything stops until probably March. But this project is in process. It's moving forward. It's not something that we just wrote down on the back of a napkin. And our Taylor project is already in construction, and we just received final approval for our Brookwood Superior project, which is bigger than this, and we'll be starting that in the summer of this year. And this talks about our development process snapshot. So, and I will announce today that we're complete with phase 1. And we just made a major milestone in phase 2. I just got off a conference call with 14 HUD employees from the Chicago office. We are pursuing a HUD-backed loan under their multifamily senior mandate. Basically, they've been mandated to go out and fund these, look for these projects and fund them. The call was very successful. We are moving on to the next phase. What that gets us is a construction loan and a financing loan at 5.82%, which for the return to our investors is going to be dramatic. Instead of paying 8.5, which we all know what money costs right now, this HUD-backed loan will allow us to achieve and go beyond what you're going to see from Danny here in a minute in regards to our ROI and our IRR returns. Now, next slide. Before I hand this off to Danny, who's going to go through these numbers and the financial model, I just want to stress that we are fully approved Regulation A plus raise, meaning that every investment has to go through a broker-dealer, and we have to do all the reporting to the SEC in fully audited books and transparency. So your investment will be protected when you come in with us. Danny? All right.
Hello, everyone. So unlike Chris, who can boast about not having the same coat on during the video, I can't really say that. So the same one. But yeah, so really exciting stuff here. And I'm not going to deep dive too much into the numbers right now. We can do that after the fact. We have a full prospectus. So we could spend 5 hours on the numbers if you guys wish. Just trying to give you guys a quick and dirty high level on this. So on the source of funds, the total project cost is approximately close to $75 million. We're looking at about a 65% LTC, loan to cost or loan to value, depending on how you want to skin that cat. I like cats. On the equity side, it's close to, we have the Regulation A Tier 2 approved for $30 million. We're approximating closer to $28 million, but we have a little bit of a buffer there with a total value of about $74 million, the total cost of investment in the project. And breaking that down a little bit of use of proceeds, you see there on the $56,700,000 and change. That's, you know, earthwork, land acquisition, marketing. You go to the counterclockwise, about $9 million land acquisition, construction cost, and it breaks down from marketing, offering expense, contingency, general contracting cost, development fees, all in about just shy of $75 million. And then it's got a very respectable rate of return ROR and ROI of an annualized 10 to 16% on the ROR and close to 26% on the ROI, and that's annualized. So commensurate to the exit, that's year over year, you're going to get all that money on the exit. And then last but definitely not least, so this is, you know, like any other investment of this sort, it's a fund. So there's a holding period. But while you're in that holding period mode, you're going to receive some preferred passive income of a minimum of 8%. So then commensurate to it being a more profitable that we anticipate conservatively, it's going to be more of a blended 10 to 14% commensurate to stabilization. That means we have to be renting these. This is a build to rent business model. We're not selling them. So we're only going to sell on the exit to a larger institution, their entire portfolios. So a blended rate of more like 10 to 14% will be paying out stable, commensurate to stabilization on the project.
Shane just said we have close to rapid.
Oh,
So,
okay.
yeah, we have a whole lot to go through, but we're just touching on it.
Sorry, yes. What was harder than
Yeah, so if there's, we have about 3 or 4 minutes, so let's go Q&A. If anybody's got any questions. None?
Yeah,
Okay.
we'll start from our panel. So Gary's going to go ahead and start us off.
I was looking at the numbers here, and I saw you talk about an IRR of 16 to 21%. Given that NASDAQ is doing 15%, that's better than NASDAQ. Good, and it's equity, you know, hard money backed, hard asset backed. Sorry. What is this 8% preferred pass? Is that on top of the 16 to 21%?
Yeah, great question. The IRR, ROI, yeah, the IRR and ROI is commensurate to the exit. The 8% is the, call it for lack of a better term, profit distribution. So once, this is a rental business model built to rent.
So that's an annual
That's
8%.
an annual commensurate to stabilization, which by 2025, we anticipate stabilization of the project. And then it'll start paying minimum of 8. Anything above 8 is a 70-30 split, 70 to the investors, 30 to the principals. So a blended rate at about 10 to 14%.
Well, thank you for your presentation. So it's certainly wonderful to have, you know, this kind of community for seniors. Now, I don't know your market very well. Could you just kind of share with the audience, in the sort of like your general area, what kind of occupancy rate do you see for comparable communities
Yes.
like this?
Great question. So before we even started this project, we hired a third-party company called ProMatura. ProMatura did a feasibility analysis for us, so we didn't buy the land just because it was a great deal. It was a good deal, but it's most importantly, is it viable? Is it feasible based on a SWOT analysis, the whole 9 yards? So in our primary market area, the PMA, about 10 to 50 mile PMA, there is no other independent senior living project around us. The median income in that area is well over $83,000 to $88,000 median income. It's a beautiful little township. 3 miles away is the downtown. A half mile away is Lake Fenton. It's a beautiful area. And
Danny, I'll answer your question. So HUD came in and did a study for us in order to take it to the next level. They anticipate in the next 3 years that there's a demand for 448 units. We're filling half of it in that market. That's it.
Great, great, good spot.
Short answer.
Yeah. So how much, just quick follow-up, how much do you price into or factor into your budget in terms of like, you know, cost overrun and all that stuff? You know, life sometimes is unpredictable, right?
yes, we call this contingency cost. Let me see if I have it on here at all.
Roughly 10% on the construction.
Yes. I was
That's from our past experience with
Yeah, I was going to show you in dollars, but the 10% is the percentage.
So first of all, I think the video was a little bit dodgy, but it was actually very compelling. It's a beautiful project. It's really something people can really, I think, enjoy looking at and see themselves there. I think a lot of your answers to questions were questions that we all had as a panel, so I would encourage you to anticipate those a little bit better and sort of get right up front with the numbers and, you know, the cap rate, the internal rate of return. Real estate just kind of gets down to what the project is, how much it sort of breaks down into getting into all the demand that you're talking about. So the major question you answered for me was, where is it going to be? Because if you're having investors from Texas, Dallas, Houston, and Austin, you know, you might have to be beyond Buddha here in Austin to get anywhere near a land price that works for this. And so you have to really anticipate those points. And so then you kind of get to the numbers finally, and I think those should be more prominent. So you'd want to dive into that as an investor, but the concept is really solid.
Thank you. Yeah, it is. And we do have all those numbers. We just didn't get to it fast enough, so you're correct. Yes.
I have another question about numbers. So is this the only raise you anticipate, or what's the projected runway for this?
This is a $30 million raise on this particular project. We do have a family of 3 other within the Brookwood Estate portfolio, so we'll be doing subsequent raises commensurate to this one being completed. Yes.
But under the Reg A stipulation, they're all separate.
They're all separate, yes. We'll be around after, if anyone would like to chat, we're here. Thank you.
Thank you so much, Brookwood. Yeah, great job. Let's move on to our next presenter, Dry Saver. That's going to be Jack. Here we go. Got a lot of mic choreo going on here.
All right, I'm going to be presenting a product that both is a security product as well as an energy-saving product, and it's a Lint Alert app. Okay, next slide. Okay, before getting into the problem, I think we need to know the current situation. The National Fire Protection Agency states that every year, there's 90 million dryers in the United States. Every year is about 15 deaths, 400 injuries, and 200 million in property damage, which is pretty much understated because your average appliance repair guy will go in there, repair a dryer motor, and the homeowner's not going to file a claim because they don't want their insurance to go up. Probably $500 million in property damage. Okay. So warnings of flammable lint buildup verified by anybody from the National Fire Protection Association, all the insurance companies. If you go online, you're going to see Allstate, State Farm, Consumer Reports. Everybody's talking about flammable lint buildup. You can look up Martha Stewart or Bob Villa, and they're going to have something on their websites. Okay. So the problem, highly flammable lint buildup and clogs inside the dryer and exhaust vents kill, destroy property, and waste energy, which we'll get into in a little bit. But you look under the cause, I mean, lint buildup is everywhere it starts from inside the dryer. There's crimp vents when you push the dryer back against the wall. You're going to crimp it, and lint's going to build up there. Inside the exhaust hoses, all the way up to the roof. We engineer our product so that it detects lint buildup all the way up to if you have a dryer in a 2-story home in the basement, it'll detect it up to 90 feet away. Results, dryers run longer, hotter and harder, and as a consequence, they start on fire, the motor starts on fire, or burns the house, okay? Solution, early detection lint alert apps. It alerts homeowners and property managers of highly flammable lint buildup right before it starts overheating the dryer and wasting electricity. So it detects the restricted airflow up to 90 feet away. How it works is pretty simple. Number one, there's a device that monitors it. Simply twist on the back of a dryer. The dryers all have 4-inch diameter exhaust vents. So this is universally designed to fit all 100% of them. And you twist the vent on, and then it sends an alert to the board, the PCB board, about the building up of lint right before it starts working harder. And then it notifies either a property manager, a homeowner, or a contractor. And then it prompts the contractor or the homeowner, hey, you better clean out your vent before it starts working longer. In fact, the product was invented by a partner who's been in the appliance repair business. 90% of his calls on dryers, he does ovens and everything else, is by dryers taking too long to dry. Well, he goes over there, pulls his dryer out, and pulls out a big clump of lint. And that's what happens. And invariably, the motor's already burnt out. Okay, next slide. So simple app-directed DIY installation. Everybody installs now. They kind of done away with inserting installation instructions. Basically, you twist it on the back of the dryer. You put the vent hose on the opposite side of the sensor, which I've got a sample here. And then it connects to the adapter, plug it in, and then you download and register your app. Energy savings. This is another huge attribute. Because dryers, once they hit a certain point where they start running longer and harder and hotter, the amount of energy accelerates, potentially going up, and that's where most of these fires that burn out, you know, a lot of homeowners, it kind of sneaks up on you. If your dryer's set to run 35 or 40 minutes, once it starts burning up energy, it sneaks up. All of a sudden, the homeowner says, well, you know, it's like 50, 60 minutes. My dryer's taking too long to dry. And then they don't know anything about this. So they'll call the contractor up, an appliance repair guy. He'll come out and he'll pull out all the lint. And by then, they've already burned 40% more energy over maybe 4, 5, 6 months. So obviously less energy usage, less carbon footprint. In fact, one of these days, I'm going to take the 90 million dryers and figure out how much impact it would have on the carbon footprint if everybody had a dry safer. Okay. So as far as competition, there's a product out there called Lint Alert, but the big takeaways on there, if you look on the left, Dry Safer, we have all these attributes: do-it-yourself installation. Theirs requires a contractor actually to drill a hole into the exhaust vent to monitor their air pressure. And the big takeaways on the lower left, we're going to talk about in a minute, is data capturing, which allows, and because it's a do-it-yourself item, getting into Home Depot and Lowe's, Home Depot and Lowe's buyers will not put the Lint Alert in because they will get a lot of returns. And then it also allows us to get into the property manager channel. Okay. If you look at I won't go into a lot of this, but this is what the Lint Alert installation manual looks like. And if you look at the middle, all those tappings you have to put in, nobody's going to want to put in those tappings and drill in a hole. Okay. Marketing and sales. What's great about this product is that to reach the 90 million dryers, We're going to be able to partner up with a whole diversified number of channels. We got the home security systems such as ADT. All the property managers like Greystar's got 800,000 units. The Home Depots of the world, QVC. I mean, everybody is going to be involved with putting this in because they're already calling on these companies with their security systems. So our first wave is B2B to Z. We're going to have a Z-Wave app that the ADTs of the world and Honeywells, the fellows, we've got two guys that are kind of gurus in the home security business. They've been involved since the advent of home security. They work with Honeywell. They can walk in the offices of ADT, present our app. And once we get to that part, then we've got a Wi-Fi app that we'll show you a demo later on. And that one will allow us to get into the B2C channels of the Home Depot, Lowe's, Best Buys of the world. And then the next will be monetization, which is huge. And that'll take us to the next slide. Okay, we've got in our software a patented data capture monetization where we can go into the property managers. The big thing with property managers in a lot of states, every 2 years they got to clean out their vents, whether they need it or not. So if you got 400 apartments in a building, he's got to get these contractors to pull out the dryer, pull out the exhaust hose and see if there's lint in there. Well, there may only be 20, 25% that have lint buildup because the tenants could be a young couple that wash their clothes 4 or 5 times a week, as opposed to somebody that, a family that's washing them 3 times a night because their kids are playing soccer or whatever. So what it'll allow the property managers to do is when they get an app on their desktop, they'll say, geez, you know, apartment 220 needs to be cleaned out. And maybe every month there might be half a dozen of them. They'll call a contractor and say, you know what, go ahead and clean these out. And instead of cleaning out 400, maybe they'll only clean out 50. And they've been the ones that have been telling us they're waiting to get their hands on this. And then also on the app data collection, imagine if you're a Samsung or a GE, and even a property manager or a appliance repair company, they have the demographics of your customers. For instance, like we get our grass, we have a weed cleaning company or whatever that sprays the grass, and they know what kind of grass it is, if it's under shade, under sun, etc. And so they can kind of formulate their formula. The same thing with if you're with a appliance repair company and you've got on your data your 500 customers, you're going to know when they need to have their vent cleaned out, so you can call them and say, hey, look, you need to get your vent cleaned out. When can we schedule an appointment? It's going to be huge. Next. So forecast. You know, there's 90 million dryers out there. Everybody says, well, if you go for 5% market penetration, you're looking at 4.5 million dryers times 75, 80 bucks. It's a $350 million company in 4.5 years. And we can bypass, what we're looking at is 0.5% or 450,000 dryers. Now, if you look at the bottom there, if we get into like an ADT has 6 million customers, even if they put 10% in their customer base, that's 600,000 units. That kind of blows away the 450,000. But we'd rather like underpromise and overperform. So it's fairly conservative, obviously, a forecast. Okay, next slide. So as far as how we're going to go to market on this, I've been involved with companies over $150 million. I've managed $14 million ad budget, introduced over 300 million in products. Tom Asciola, my partner and inventor, has owned a successful appliance repair business. He does about 10,000 vent cleanouts a month. That's just a month. And there's thousands of companies just like him. It's a big business. There's companies that do nothing but do vent cleanouts. It's low capital. All you got to do is get a couple of leaf blowers, and you go in there and you blow out the lint, and these guys are making tons of money. And then Randy Russell, who's a guru in resin technology, is a manufacturer. He's got a million unit contract to produce 1 million elbow pads and 1 million knee pads for the U.S. military, and he just knows everything about resins. He produced the first 3 generations of our product. Next. And then the two fellows, Avi Rosenthal and Mike Buckingham, they've been in this business forever. Avi knows all the board manufacturers, the keyboard manufacturers. He actually does business with a lot of them. He said, hey, Jack, why don't we produce something in Mexico? We're looking at Mexico, and we've got quotes in Taiwan. And then Mike was involved with the Yale lock Smart Lock, and he's been involved with home security as well. So of the 5 of us, I know we were looking at the number of years. We're a bunch of old guys over 150 years combined. Okay, so, and we know everything, every part of the business model. I mean, manufacturing, cost improvement, you know, the whole works. In the next slide. So we're looking at, seems like a lot less than what you guys are looking at. $600,000 at $1.25 a share, tranches of 15,000, and right now we've got 3.7 million in shares outstanding, and it would bring up to 4,150,000. That comes out to about 480,000 shares, or about 11% equity. And we've out of our own savings have put in over 200,000 bucks. So it's been kind of a long haul, but we've gone through a really deliberate process of going through each of the first 3 generations. In fact, if you want to go through a couple of slides later, I just want to show you something which is a little detailed. A couple more. One after, okay, well, there's the use of proceeds. You know, we've got about, out of the 600,000, you can look at 100,000 in developing the Z-Wave. We already paid for, by the way, the Wi-Fi model. We'll show you an app real quick. And then another 200,000 in marketing and business, and then 300,000 or half of it into inventory.
You ready to get into some questions? Sorry, we're just running a little bit on time here.
Pardon?
Are you ready to get into some questions? Cool. Let's just pass it over to the panel. Get it started. Who would like to start for us? Start with our panel, and then if we can get over to you, we definitely will.
This question may be better than mine. So I'm allergic to dust and also mountain cedar, so I'm very much behind the the product. So the only thing I don't really like, to be honest with you, is that it really doesn't have a direct consumer, like online model that I could figure out from there. And I worry about if you're staking the future of the company on a Home Depot.
Hold on a second.
Did I miss that?
No. Okay.
Yeah, Home
I got
Depot.
a call in, but okay. So we don't have what?
Well, I mean, all of your backgrounds are dealing with really big indirect or channel sales. And those are great, except they take a long time. They cost a lot. And you're always at the whim and fancy of a big channel partner. Like you get in Home Depot, like if you get in Walmart, Walmart can kill you as well as help you. So you have to really watch. So I think you'd be better off starting with the direct-to-consumer and using that to undergird your channel marketing program, just as I see that. But I think it's analogous to really creating the same demand as a fire protection unit. When they started out in houses, no one really knew what those were either.
Right.
So I think if you kind of model after what they're doing, I think it really kind of launches your marketing. Everything else looked really, I mean, it's a great product. Maybe cost would be competitive, but you know, that's the only thing I would like to see as an investor.
You want to go to the exit strategy slide? It's good input. We've sold, in one day we sold 1,250 units on HomeDepot.com, and we've got the reps that we have, I've known for 25 years, they're former buyers, and all the reps that we hire, we want to make sure they're former buyers. So our Home Depot rep, Paul Brennan, has worked for Home Depot for 20 years before he started his own agency, and these guys have great relationships. 2 more up on the exit strategy. Okay, next, but good input.
Yeah, so following on that question, I understand the market size, 90 million units. Got it, that was clear. How many units did you sell last year?
Well, okay, good
or
question.
Or the year before that, or year before. And
we
any of
sold
the last
probably the first generation, which was trying to prove out the concept, sold maybe 1,500 units because we wanted to get in to see what the input was. It was more of a test marketing. Next, second generation, about 5,000 units because we tested it out with a home improvement center, Menards. Third generation, we were in 400 stores with Lowe's, and now the 4th generation with the app. And we found that with the challenge with retailers are you're at the mercy of the execution of the store manager. You know, like with Lowe's, the buyer said, hey, Jack, I'm going to put it in the front where, you know, you get the orders for a dryer or washing machine, and every one of our guys are going to say, oh, by the way, you want an 18-month interest-free program, or do you want a warranty? And, oh, by the way, you ought to buy a dry safer. Well, that didn't happen because execution. Whereas going with the ADTs of the world, they've already got the customers and they can just add it on to their installation.
Yeah, I guess my thinking or question here is there's a market opportunity of 90 million, but that's your view of this market opportunity, but the demand seems like it's much, much lower. And the issue, I think, is education, right? So they don't know they need this product. So I've owned, I don't know how many houses, and I don't know how many dryers, and I have no idea the amount of lint buildup they've had. I can imagine it's an issue, but every time I've had to work on the damn thing, it doesn't seem like it's a problem.
Well, that's a good question. And again, that all comes back to the business development end of it with social media and getting the PR and getting the awareness of it, just like any other product, you know.
Exactly. And so if I was going to give you one piece of advice on this discussion is you need to have a slide of how you're going to educate and create demand. It's really about demand creation. For you, it's really all about demand creation.
Right.
And I think you're trying to find ways around doing that by using ADT and other forums or other distributors. But that's going to be the problem for you or them.
Yeah.
Is like, how do you create demand for this opportunity?
And we thought about that. A good question is when we partner with, say, an ADT or these home insurance companies, and they put it on their, like Home Depot, for instance, gets 10 million hits a week, and Amazon. Once we get partnerships with those companies, they'll put it on their website, and we'll piggyback on their expenditure, their ad funds. So, you know, we'll have some too, but it's going to be getting with them, the partnerships with the Honeywells of the world and the Vivants, and then they'll be pushing it.
Sure. So very quickly, what kind of gross margin are we talking about? And
Pardon?
What kind of gross margin are we talking about?
55%.
Okay. And just curious, why is it that you can, for this offering, you do a common stock offering as opposed to preferred stock? It's actually quite unusual for this stage of the company. There might be a good reason for it. Just curious.
Well, we just want to get somebody interested in getting equity. And with preferred stock, then we have to get into the interest buildup. And we have to say, okay, you're going to get X amount back. We're looking at about a 5 times earnings on a per share. So we just found that just doing a straight equity deal would be more enticing to investors.
I think you and I can discuss offline, and I think that it may limit some of the investor interest. But okay, good.
Awesome. Well, thank you so much, Jack. Great job. Take that. All right, and next up we have PayTrust. Nathaniel, come over and take this away from me.
Good evening, everyone. Thanks for listening. So I'm Nathaniel Eberhard. I'm the CEO of PayTrust. Our goal is to help consumers pay all of their bills on time, every time. Next slide. PayTrust is a union of two different services. The first is Silver Bills, a concierge bill pay service founded in 2014 by Marcy Lobel Esrig. I joined in 2019. And PayTrust, a direct-to-consumer digital bill pay service that was actually founded in 1998, was acquired by FIS, Fidelity Information Services, which is a $33 billion market capitalized, publicly traded fintech company, and has been their direct-to-consumer arm for the past 12 years. They decided, for strategic reasons, to exit the direct-to-consumer space. One of the biggest reasons for that is because they want to do business with more startups like us. We agreed to purchase on deferred payment terms the PayTrust brand, customer book, and mail facility, which I'll get to in a bit and is very important, from them in July, and built out a digital service over the past 6 months, which launched on January 3rd of this year. Next slide. So 42% of adults over 50 have difficulty paying their bills each month. Many also struggle with managing their mail. Just the pile of bills stacking up on a dining room table is a sight that greets many people when they go and visit an elderly relative. And the combination of those two problems is what PayTrust is built to solve. Not paying your bills on time can have huge consequences, which I think can be relatively apparent to anyone who's ever just thought about this problem. Obviously, interrupted vital services is a hugely significant one, but declining credit, just the administrative time that it takes to pay bills via check or using phone bill payment systems is a drain on your just free time to spend on other things. So it is an enormous societal problem. Next slide. We focus mostly on the older adult market, but bill pay is something that many people struggle with. 72% of consumers are in some sort of the collection process, and many struggle. I have a whole bunch of reasons there that consumers report for being in that status. And we've built a technology, a suite of technology that can both discover the collections and bills that you have outstanding, and then work to get those paid off and for current obligations paid on time. Next slide. So we have two plans. One, PayTrust Convenience, which is a successor to the former all-digital PayTrust service. So we have actually built out a UX ourselves for that. One thing that sets us apart from any other bill pay service on the market, including Rocket Money, which is a big name you might have heard of, is that we do provide both an @paytrust.com email address and a physical mailbox to which all bill pay correspondence can be directed. And that mail facility came with the PayTrust acquisition and is located in Sioux Falls, South Dakota. For PayTrust Concierge, we offer the same suite of digital tools as we do for PayTrust Convenience, but also we include a US-based account manager who a user can reach by phone anytime. You can interact with us for the concierge business entirely over the phone and through the US mail. No digital literacy, computer use, or even smartphone use is required. So between those two services, we can basically help anyone, whether they want a convenient online digital experience or a full service account manager mediated service. Next slide. So our three pillars of service are just for the concierge business. We do have that personalized support. For both, we have that all-in-one single platform for all of your bills, including those that come in by mail, those that come in by email, and those that you upload to the app. And then additionally, we have security tools for fraud protection, for identity protection, and a full suite of reporting capabilities. Next slide. So PayTrust today has 4,000 users and a database which we have yet to market to at all of 124,000 former users of the PayTrust platform. Our ARR is $1.2 million as of this month, and $1.4 billion has been spent through the program over the last 24 months. For the PayTrust Convenience Plan, the average user pays $21.14. It's just over $130 for the PayTrust Concierge. Next slide. Our bill pay engine has at its core FIS's flagship Fusion product. On top of that, we have built our own AI-enabled engine for scanning bills, whether they come in through the mailbox, by email or by upload through our app. You can just take a picture and upload it. And we allow payment out from any bank account that you want, up to 10. We also support Zelle and card as well. Next slide. So the marketplace has shifted even in the past 6 months significantly. There are a number of free services, including Mint, Fiserv's My Check Free service, all of which have been shut down. So there are a huge number of people who used to get a free service that is no longer available. And there are also many people who use a professional service, an accountant or what's called a daily money manager, to pay their bills, but who do so in a relatively inefficient manner. Our account managers this is all they do. So compared to using your accountant to handle your bills, which many wealthy older adults do, our service can do it at a much better price and with a full suite of digital security behind us. We do have a SOC 2 certification and a HIPAA certification showing our data protection capabilities. Next slide. It's a huge market opportunity. The amount that consumers are costed by late payments and credit charges for non-payment are enormous. Next slide. And we have really great partners to help distribute our product. FIS, obviously, from both a technology perspective, is really vital. They're also going to help us distribute through the banks that they deal with. We have achieved 2 SBIR grants from the National Institutes of Health, totaling $4.4 million. The first piloting our service to caregivers for patients with Alzheimer's disease, and the second focused on LGBTQ plus older adults. We also have contracts with Humana already in place and United Healthcare as well. Next slide. Our gross margins are relatively healthy. Obviously, we'd like to get them above that current just about 20%. We're confident that further automation and economies of scale as we grow will allow us to do that. Next slide. Our growth, especially through this Patros acquisition, has been pretty incredible over the past 18 months or so. I mentioned that ARR number of 1.2 at the present time and 4,000 clients on the service. Next slide. We do expect really massive growth over the next few years. The starting point of that is going to be these former Patros users who we're going to be marketing to, expanding the partnerships that we have with those insurers, and especially guardianship groups, which is a huge industry in the United States. They pay bills for millions of Americans, but there really isn't a service available today that is specifically targeted towards them and makes the specific bill pay process really easy. Next slide. So we are looking for $4 million. The majority a plurality of that going to marketing our service. We still have a lot of work to do on the technology side, building out further AI-enabled tools for financial advice, smarter alerts, and a number of other things. We have a relatively modest overhead level, and we're confident with this new dual product set that we can grow quickly. Thank you so much, and can take any questions.
Great, thank you, Nathaniel. Who wants to start us off on the panel? Pass it over to you.
Thanks for a presentation. So yeah, helping consumers to pay their bills certainly is a very, it's a tall order, but it's great that you're attempting that. Just curious, so one of the slides that you show, you have currently 4,000 users, and you've been around for business for 25 years. And there are former consumer customers of 124,000. So what are did you guys do any research as to what could help you, like keep these customers? It seems like there's quite a bit of churn there.
Oh, most certainly. So the direct-to-consumer business was not a huge focus of FIS. They did not spend a lot of time on PayTrust, and there are a significant number of users who did leave. We have built an entirely new digital program. We have an entirely new customer service organization, and we're confident that we can bring a lot of those customers back. If you read some of the online reviews, you'll see that it was, before it was acquired, a really beloved service, and we're working basically to bring it back to the place that it was with our own internal tech team and a bunch of new skills that we're bringing to the table. But Silverbills and the organization that I lead was founded in 2014, and we've been growing slowly but surely that concierge business ever since.
Mm-hmm. That's great. And it sounds like the average customer tenure is about 20 years. So there's something happened at some point that make them a little bit not very happy. And has anything changed to help you sort of be confident about getting them back? Could you go a little bit deeper?
Sure. So really, the biggest thing is just a more modern software experience, and I'm happy for anyone here to give a demo of our web and mobile app. There actually was no mobile app at all for the service, and also it was just a relatively antiquated piece of technology that had not been updated since 2012. So that's the biggest single reason why probably left.
So, love the idea. I'm sure my children are planning to use something like this with me. A couple of questions probably along the same lines. One is, you showed the 4,000 users. What is the average number of bills per user per month?
It is 12.
Or I would have guessed. All right, and the second thing is, as an investor, this is half of the data I need to start, right? You want $4 million, I get that. What is your pre-money valuation?
Oh, sorry. Next slide. It's 12.
Okay, that's an important little data point.
Yes.
Got it. All right. Good. Now I can evaluate that. I would say you should talk to me after this.
Sorry, say again?
You should talk to me after this.
Oh, great. I'd love to.
So I applaud you for working and getting that from FIS, because I've known that company for a long time. That's a great achievement to get that. I think you also need to explain why they dumped it, because that's what they did to let you pick it up. But it's sort of indigenous with the whole area of online bill pay. No one really has it quite down because it's hard to implement it. It's hard to aggregate customers, and it's really a messy customer experience.
It is.
So you have to figure that out. I would like the good comments on the numbers and the valuation. I'd like to know the cost. I mean, this is really a like the online the concierge aspect of it could work for more than just geriatrics, but I think it's you have to marry that over with it. So I think it's all in all, you're about 80% there on kind of putting the package together. So a lot of it is really great. So it's good.
Thank you.
Thank you so much, Nathaniel. Yep, steal this one too. Sorry, I gotta be the mic guy. Yeah, great job. Next, I want to bring up Windmill. Sam, oh, there you are. Oh, yeah, if you want to. Oh, go ahead and give this off to you and get started whenever you're ready. Or whenever we get the presentation
Get
up.
the slides up. Yes. While we're waiting for the slides to come up, my name is Sam Liang, and I'm pleased to present on behalf of Dr. Richard Smalling, who's the CEO of Windmill. He's a full-time practicing cardiologist. thought leader in structural heart, and he's seeing patients today, as one would expect. He founded Windmill several years ago, and Windmill is developing a transformational, what's called left ventricular assist device, an LVAD, for end-stage patients who have heart failure. And I'll tell you about that in just a moment.
Sorry about that.
It's okay. It's okay.
Sorry, we are working on it as we speak. I've never had two screens in my life, so. Also, please enjoy this picture of me eating a donut with one of my friends. Okay.
Yeah. So I have about 39 years of healthcare experience, mostly with companies Johnson & Johnson, Bayer Healthcare, and what brought me to Austin is Hanger Orthotics and Prosthetics. But prior to that, my years at J&J was running the cardiovascular stent franchise, and Dr. Richard Smalling at the time, still is, was a thought leader in interventional cardiology, and he's now a thought leader in structural heart. And so I retired from Hanger in 2020, and just as you would know, just started looking at this area of heart failure. My daughter actually worked for Medtronic, who was in the heart failure space, and she told me about this company. So I said, let me just drop by, and that's how I got involved with the company. And then since then, I've joined as an operating partner with the Revival Healthcare Capital, which also likes the company. It's just a little bit too early for our investment thesis right now. Okay. So with that, as I mentioned, we're talking about Windmill. They've developed a transformational LVAD, and you can go ahead and go to the next slide. So the unmet need that we're addressing is the 6 million patients in the U.S. healthcare system that have heart failure. A tremendous cost to it. There's a subset of these patients that are in end-stage heart failure, about 50,000 patients, and due to the lack of hearts, these patients either get a heart transplant or they get an LVAD. And due to the lack of hearts, as well as their shortcomings in the technology and innovation in the LVAD space, the penetration rate is very, very low. So there's over 40,000 patients that end up just getting some type of palliative care, and they just end up in the hospital, and they're hooked up to a machine, and they just end up dying. A very, very terrible life. The reason why there is such limited adoption in the LVAD space is that today there's only one device on the market, and it's the Abbott HeartMate 3. And the Abbott HeartMate 3 technology operates on what's called an impeller design. It's a blender that essentially spins at a very high rate, and it pulls blood into the heart. The issue with these impeller-type designs is that they damage the blood, specifically something that's called von Willebrand factor. There's a lot of science around damage of von Willebrand factor, and when that causes downstream events, which as a result, you can see on the right-hand side, these are real-world registries of patients with the HeartMate 3, and you can see that there's well over a 33%, one-third of the patients get GI bleeding, stroke, and about 90% of these patients go back into the hospital, and that's what's driving a lot of these healthcare costs and events. So it's Windmill's mission to actually change this for patients worldwide. Next slide, please. So the design, what Dr. Smalling and his colleagues, this is a spin-out out of the University of Texas. It's their IP. It's licensed from the UT scientists. Basically, it's two ceramic cylinders encased in a titanium case. And basically it pumps, as you can see, like a heart. You can also see that it's got an EKG sensing lead that's attached, to the outside of the heart. And with this, it's really essentially a smart pump. It has AI sensing rhythm so that as your activity ramps up, you're walking, you're playing with your kids, it pumps faster. And as you slow down and sit down, it goes slower. Because the piston is pumping in a pulsatile fashion, there's two advantages. One, it's very gentle. It doesn't damage blood. There's a lot of animal studies that the company has done to show how it does not damage the von Willebrand factor, compared, especially on benchtop, compared to the HeartMate 3. And then because it's pumping pulsatile, it's not on all the time, it draws a lot less current and wattage. And because of that, the battery requirements are very, very small. And you can just see up here how the system is very, very small and compact, the Torvad compared to the HeartMate 3. It's about a third of the size. The HeartMate 3 is about 6 pounds, and I'll show you a schematic. The patient wears it like, gun holsters. And with the Torvad, it has the ability just to have one very small battery pack. If you go to the next slide. So this is a side-by-side showing the system side-by-side. And look, Torvad's on the right, and you can see how it's pumping in the red, the pulsatility. And you can look at the monitor. You see it's 80 beats per minute and 2.5 flow. So what happens is the patient's increasing his activity, like he's walking, playing with his kids, 80, 90, 100 beats per minute. You notice the Torvad is pumping much harder, much faster. And then notice as the patient sits down, 80, 90, it slows down. So this is accomplished by, there's actually a lead, epicardial lead, that goes from the Torvad on the right-hand side. You can see we just put it on the outside of a simulated heart. So again, it's simulating the heart in terms of matching what's going on with the patient. On the left-hand side is the HeartMate 3. And what you can notice around the HeartMate 3, besides the size, is you can see it's just constantly churning at a constant flow rate. So you can just see how that column of water is remaining constant. So regardless of what the patient does, if the patient's trying to exert and walk and play with their kids, it's just pumping blood at the same level, the same flow rate. So as a result, patients, they get very tired, they get dizzy because the heart rate is not pumping. There's no smart sensing or feedback mechanism going to the Abbott HeartMate 3. Likewise, if you're sitting down, patients will say it's overpumping and they feel flushed, and sometimes they will have headaches. The very last thing I wanted to point out is if you can look on the Torvad on the right-hand side, you can see these gel beads that are pumping through the heart, through the device, and you can see they're perfectly intact as they're going through it. We've taken the same gel beads and you've put them on the left-hand side through the Abbott HeartMate 3, and you can see they've already chewed them up. This is the effect that we're talking about, the damage that occurs to the blood cells and the von Willebrand factor. This is really what's causing the cascade of all of these adverse events of stroke, GI bleeds. And so the promise, obviously, the value proposition for Torvad, besides being small, being physiological, synchronous to your activity, it also doesn't damage the von Willebrand factor, which also can reduce all of these adverse events and save patients, from going back into the hospital and save healthcare a lot of money. Let me just go to the next slide, please. Actually, you can just go to the next slide. So in summary, as we talk about the HeartMate 3, continuous flow, blood damage, adverse events, non-responsive to patient activity, and because it's so large, many patients just simply say, forget it, I'm just gonna, let things go and I'll just wait for a heart transplant. Many of them don't get heart transplants, and as a result, they die. Torvad, on the other hand, pulsatile, gentle, responsive to patient activities, very small system, we anticipate very high patient satisfaction and adoption. One other thing I didn't mention is because it's smaller, the doctors can actually implant it through a thoracotomy, which is just through your ribs. You don't have to do a sternotomy and crack the chest. So there's many other advantages to it, but I just wanted to hit the high points. Next slide. The company over the last several years has had several dramatic progress towards achieving clinical trials. They've had 3 generations of designs. The first Torvad that we've shown that's here, the second one is one that can be fully implantable. Right now there's a drive line that goes outside, but the next, because it again draws such a small amount of power, it can be fully implantable. And the third is a smaller device that can fit women and children. The HeartMate 3 today, because it's so large and the accessories, many women and children, it will not be able to be used in. There's a big IP patent estate, lots of animal data that have been done, many publications and presentations globally, put together a world-class team as well as a heart failure scientific advisory board. These are all leaders in the field. The company was recognized by ACC, the American College of Cardiology, a couple years ago as the most innovative technology in their pitch competition. Next slide, please. When you look at the TAM, today it's about a $6.4 billion total available market in the United States today. Abbott today recognizes on its own, because it's the only product, of $1.1 billion globally. It's a big franchise globally. $600 million is in the market in the US. And we've done voice of customer feedback of all of the world-leading surgeons and transplant folks, and they have just basically said, if I had Torvad, it would become my frontline therapy, and it would expand the patient population that I could actually put it in for all the various reasons that I've articulated. So we'd anticipate a growth in the TAM, growth in penetration, and certainly a growth in share versus Abbott. Next slide. From a financing perspective, about $15 million has been raised to date. Most of it has been non-dilutive, NIH grants, SBIR grants. Company's raising $7 million to hire a full-time CEO. We've contracted with two really great regulatory consultants. They are all ex-FDA in the space of LVADs, as well as Valentium down in Houston, contract manufacturers, to finish the product design and to work towards its first protocol. That's what the $7 million financing is. You know, there have been two exits in this market, and one is Abbott, St. Jude, and the other one is Medtronic acquired Heartwave. They've all been in the billions of dollars. Many of the strategics would be interested in this as they have call points in this area. They just would like to see first-in-human data. And obviously, this is also similar to Heartware. This is an IPO-able a company from an exit perspective. Next slide. And I'll just leave and close with this slide that comes from feedback from many of the thought leaders that I've mentioned. And basically, what all of these thought leaders have said is that if this product would get to market, it would become their frontline therapy, and that there's a number of patients that they could use to expand its utilization. And all of this is really just to benefit patients, and in addition, have the byproduct of saving the healthcare system globally a lot of money. So thank you very, very much for your time. And I've got some units here afterwards if people want to touch and feel them. Thank you.
Awesome. Let's move it into Q&A. She wants to start us off.
Sam, thank you for the great presentation. You're a great spokesperson for the company. So just curious, what do you need to do to take it to the market? What do you need to do to take the Torvac to market? And in terms of how much money, additional rounds you need to raise, and also what kind of FDA approval, timeline, etc.
So actually, can you just advance maybe 3 slides? I've got just a timeline, but go ahead, keep one more, and one more. So in short, right now, the $7 million will fund the company to the end of 2025, beginning of 2026, really fund the company for 2 years. It basically finalizes the design. There'll be another $13 million that's required to get the product to a first-in-human clinical, basically. It's called a PFS, or feasibility study here in the United States. That would occur in the 2027 timeframe, be 5 to 10 patients with success around that. Then we'd anticipate going to U.S. pivotal. And then U.S. pivotal would require about $45 million. So past the 7, another $58 million would be raised. These are very capital-intensive programs. Oh, I'm sorry.
Yeah.
Yeah.
So one quick follow-up. So how long can the Torvac stay in your body? Is it like forever till you die, or is it every few years you need to change it?
This patient population will get an LVAD. Typically, they're bridged to transplant until they get a heart. And in some cases, they'll be their destination therapy, and typically be 5 years. Yeah, but the company has done a durability testing out to 40 years. So, but typically these patients will be 5 years.
So I'm going to have to reiterate, if you're not the normal presenter of this, that person might reconsider making you the normal presenter of this. Fantastic job. I have to ask the same question I asked with the last person. What is your pre-money valuation?
Right now, pre-money valuation is about 18. Well, so right now, the last valuation that the company had was about 18 million.
Right, and I saw that on the 409A.
And so for this upcoming round, there is no set pre-money valuation. The board, again, of the 18 million, about 8 to 9 million was actually non-dilutive capital. So it's a very small cap table of just insiders, and they're very willing and very flexible to talk about it.
Recognizing that valuations really haven't changed since 22, you're thinking it's probably about
recognizing it's a very tough funding environment, I guess.
Yeah, absolutely. Okay, so I'm glad to hear that.
Yep.
That's rational.
Very much rational.
Unusual. So great to hear that. I think you also should talk to me after this.
Yes, certainly. Be glad to.
Yeah, I think I'd really talk about the FDA sooner because that's the key.
Yes.
We've done a few biotech deals, and you look at the numbers perfectly understandable with the 7 million, but you have to be careful that it's not just a bridge to nowhere because you essentially raise the 7 million and you're really not there yet. So what we found is we really latch on to a larger pharmaceutical funder or a larger funder in connection with that, and that sort of solves that problem. Not easy to do, but you're right, it's a hard market. But this is a brilliant project, no question.
Thank you very much. Thanks for the advice.
Does the battery ever need to get changed?
So yes, the batteries do get changed. So the HeartMate 3 with the 2 battery packs, they have to recharge it pretty much every day. With the Torvad, you got about 10 hours with it, and you can pull it out and then you can put it back in again. So, but the batteries are external, at least in these first generation products, and pretty much every single day they need to change them. The difference is you have to change 2 with the Abbott product, and with the Torvad you'd only change 1. And the interesting thing is that so the Torvad actually has a battery in it, so that if the battery ends up like accidentally dying, there's enough resident charge to keep it going for another hour or 2. Because it's only pumping every now, like a heart. It's not on all the time. It draws a lot less current. Okay, thank you very much.
Thank you, Sam. Great job. Yeah, great job. Next up, we have Pete Ferrari from Global Foods Group. And go ahead and hand this up.
Good afternoon, everybody. I feel like I need to bust out a little Sinatra with this mic in my hand. I haven't used one of these before. So my name is Pete Ferrari. I'm the founder of a Global Foods Group doing business as Healthy for Life Foods, which you'll see any moment here. So basically, we're bringing a rare sugar to America, and we've named it Jaca. So the course of the next 10 minutes, we'll describe this rare sugar, some of the merits, and walk through the business plan as well as the model. Or maybe I will jump in to fly me to the moon while we're killing time.
Again, apologize.
Please. I think that's actually a great question, and I think you're going to like the answer. Basically, this is compelling and paradigm shifting because it's actually a sugar. So it's not a sugar alternative. It is a monosaccharide. It's got the same molecular composition as sucrose, the sugar we grew up with, but the molecules affix themselves together differently, which basically changes it from a poison into a superfood. The reason why that's important, and the most important thing to take away from the 9 minutes here, is that this is a sugar, so it tastes like sugar. It cooks like sugar. It bakes like sugar. And if you've ever had products made with stevia, truvia, sac, they taste like a wad of tinfoil, like you're chewing on a bag of nickels. So this really is a very unique opportunity for us to bring a sugar into this country where there's little or no awareness and really establish ourselves as a thought leader and a dominant brand. I'm sorry, I didn't hear that. Well, yeah, if we had the slides up, you'd be getting all these questions answered. So you just keep lead the witness. Yeah, this is interestingly a sugar that was first identified in the 1970s. So it's been around for quite a long time. And it's heavily used in Japan, probably the healthiest culture on the planet, north of 4,000 products. They use this sugar to the extent that we use stevia here in this country. But stevia has now been shown to mutate DNA. The reason is the big food and beverage companies. The reason is naturally the FDA. They've got their own agendas, they've got their own narratives, and they've been able to keep this sugar down primarily because it's non-addictive, right? They don't want to bastardize their current supply chains. They don't want to reformulate their recipes. They want to keep the generational clients in place, keep them addicted to sugar, keep pushing product, and keep meat in the street. These companies have known about this sugar for decades. Cargill's got a $4 billion R&D department. So they've known about it, and we'll talk a little bit about that in a minute about one of our advisors. They just don't really want any part of it. So again, my name is Pete Ferrari, founder of Global Foods Group, Healthy for Life Foods. Next slide, please. Talked about this, sugar is the new cigarette. Cardiovascular disease, metabolic syndrome, certain cancers, asthma, liver disease, hypertension. It's interesting because while 77% of Americans are trying to reduce their sugar intake, sugar is still preferred 4-to-1, due largely because of taste. So basically, that's why you find yourselves with a CAGR in the sugar market of 8.01%, and the CAGR for all other sweeteners combined is only 4%. There has not been a remedy for the taste problem. Enter Jaka. Next slide, sir. Jaka is actually a monosaccharide, same molecular composition as sucrose. They fix themselves together differently, which changes it from a poison into a superfood. It has got all the formulaic badges that you would want: vegan friendly, non-GMO, halal certified, vegan, organic, 90% less calories than sugar. It's actually been clinically proven, randomized, double-blind, placebo-controlled human trials, not rats and mice. It's been clinically proven to decrease subcutaneous and belly body fat, control appetite, and inhibit the body's ability to assimilate new fat. So it's got amazing health benefits in addition to all the badges that you would want. The most compelling figure on this slide is, according to IFIC, International Food Information Council, less than 15% of Americans have ever heard of this sugar, which gives us a greenfield opportunity. Now, I've been doing this for almost 2 years, building out the infrastructure for this company. I think that number is actually less than 5%. Next slide, please. Market's huge. Obviously, sugar's found within 80% of foods and beverages in this country. There's more than 60 ways to hide sugar on a nutrition label. While we do have a global penetration plan and a hub and spoke model, I do have the ability to extend out throughout the globe day one. Our supply chain has been designed to ship domestically and internationally. We think the $2 trillion grocery portion of the $3 trillion consumer product goods industry in this country is going to be enough to get us going. Next slide, please. I'm trying to speed up since we got held up. We've got obviously a multi-pronged approach to the business, and we'll talk through a lot of that. The primary prong for the business is the direct-to-consumer model over the internet. To your point, I could not build a sustainable or a scalable business being subject to the whims of a Cargill or a Nestle or a Unilever. Couldn't do it. Nor the Krogers and the Publixes of the world would I would be vying for shelf space. That's very, very expensive. And to your point, this is very much an early adopter type of model where education and awareness is going to become paramount. Direct-to-consumer is the answer. You look at what Lip Kit's doing, Gymshark, Fashion Nova. You look at what Movement Watches is doing. These companies are going from 0 to 100 to 500 million to $1 billion overnight. My favorite story is Dollar Shave Club. Dollar Shave Club was started 110 years after Gillette. They doubled Gillette's revenues in 3 years. Razor blades on the internet. Once we decided we were going to go in a direct-to-consumer model, I went right to the Don Corleone of social media and internet marketing, Gary Vaynerchuk. So we know Gary V. We deployed almost our whole first round of capital with Gary to develop the name Jaka, logo, branding, theming, iconography, packaging, e-com infrastructure. It's all done. This second round funds inventory. So it's a very interesting way for us to address the market one-to-one, educate, create awareness. We're also working with a guy named Phil Laboon, lead stacker. He's another big tech guy. He's mastered funnels on the internet. He's got a heavily integrated funnel CRM system that we're going to be using. And in order to foster, again, education and awareness, we've created a number of health and well-being modules that we're going to be offering to the consumer to add value, and then bundling Jaka in, using it as the catalyst because of all the aforementioned merits for this actual sugar. Next slide, sir. Naturally, we're developing products, developing SKUs. I love the CBD space, highly fragmented, no thought leader, no dominant brand, explosive growth. The interesting component here is when I build a product in the CBD space that's got Jaka in it and all the aforementioned health benefits, I'm going to be able to put that stuff on my label, and that's a massive differentiator in a space that's crying out for a leader versus all these other sweeteners that these other guys are using, where they're basically injecting carcinogens into their formulas. We're working with a big beverage manufacturer. We started out with these guys, developed one drink. We went with one Jaka-powered beverage. They put us in a blind taste test against 9 people. with 9 people against one of their current beverages that's doing really well in the market. 9 out of 9 picked the Jaka Power beverage. We've now expanded these talks to include 5 drinks, 3 non-alcoholic, 2 alcoholic. So it's been a very fruitful partnership that we're working through the final throes of. As well, a worldwide distributor of confections and a gummy manufacturer. So these are all on the horizon, all to be introduced. Next slide, sir. Close to my heart, another prong of the business model is a voucher program that I've developed. It's important to note, I think, that in order to scratch my itch when I got into this business and got out of real estate development, I needed to crack the code for the impoverished community, which is what I come from. My dad was killed when I was 10 years old. I spent a huge chunk of my life in extreme rural poverty. I actually slept in my car at certain points while I was putting myself through UConn. I get it. I know why sugar-related illness hits the impoverished the hardest by far, because sugar's super cheap and it makes crappy food taste good. That's how my grandmother did it. That's how she got me to eat dandelion soup when I'm 10 years old. So I figured out a way, using a derivative of a patent that I co-authored in the 90s in tech, to develop an apparatus and a mechanism to distribute this sugar into impoverished communities. Accessibility being one of the major problems that the impoverished have. They don't have accessibility to good products. I've also cracked the code with the affordability, the other major problem for the impoverished. They can't afford good products by putting us in a position where we're going to be able to obtain subsidies. Healthcare providers have a $1.72 trillion annual problem with obesity and obesity-related illness. They can't move the needle. They're dying to proactively move the needle. You get them off of sucrose, you get them onto another sugar that they're going to like the taste of, and you can have a needle-moving event. The HMO that we're working with that's helping us do some analysis initially found that up to 20% of their at-risk customer base could save 1 hospital visit per year, and they value 1 hospital visit at $10,000. So if you look at the 220 million members across 3 healthcare companies, you're talking about $220 billion in savings per year alone from these 3. Next slide, please. Again, back to my roots, 501c3, we have established the Foundation for Nutritional Equality. I believe it's important. This helps the company propagate its message where the for-profit company cannot go. I can get into churches, I can get into community groups, community centers, I can get into school systems and really teach people about the notion of this sugar, the good health and well-being component of this sugar, and help them wean themselves off of the toxic and poisonous cane sugar. There is no competition, right? You guys have all seen the news, erythritol, now the studies, heart attacks, strokes, tachycardia, sucralose, which is Splenda, downgraded by the FDA from caution to avoid, causes cancer, aspartame causes cancer, sweet and low causes cancer. Not only they all cause cancer, they all taste like shit, right? So now you've got a product that tastes like sugar and it's actually good for you. Paradigm shifting ingredient here with no presence in the United States. Financial projections are strong. 17 million in the first year. We talked about the direct-to-consumer model. I mean, it's just so effective. I've outsourced the supply chain, co-packing in Edison, New Jersey, 3PL in Greensboro, Georgia, the ability to scale to millions of packages day 1, ship domestically and internationally, appreciates to 120 million in year 4, 212 million in year 5. And I think the interesting note here, it's very important, I kind of stole Eric Anderson's thunder here from Topgolf. I'm a big fan of his. What he did in building that company and selling it to Callaway, I think is just magnitudinal. So when he was putting the numbers together for his financial models, he distinguished between what he called core value and option value. So when he was putting together his numbers, he never put anything in his models initially that were not a person going to Topgolf, paying money to swing a club and hit a ball. Advertising revenue, sponsorships, co-sponsorships. He called all of that option value or back pocket revenue. None of it was in his models. We did the same thing here. This is only direct-to-consumer sales of products and pouches of sugar. It's not distribution agreements. It's not co-branded deals that we're working in full effect. This is a great way for us to be pretty conservative about what we're doing with these numbers and then have a happiness problem, hopefully, at the liquidity event 2 years, 3 years, 4 years from now. Team, this will be the 5th company I built in the last 30 years. It's what you might expect. Our board of advisors is strong. Dr. Rona Applebaum was the first ever chief science officer at Coca-Cola. She's by far my favorite advisor. She's a monster in the space. Dr. Tom Oran's the inventor of Craisins for Ocean Spray. Actually catapulted the company from a juice company into a food products juggernaut. Dorn Wenninger ran the country of Mexico for Walmart, an $11 billion P&L. John Crane went to Southeast Asia 20 years ago and established the JP Morgan base of operations for them. He's a Wharton guy, super, super smart. Notably, John Majeski is new to the board. John is the founder and CEO of a private equity group in California. Not only did he agree to be on our board of advisors, but they're also investing in the company. And I know you guys know this, private equity groups almost never put money into early stage companies. They're always waiting for significant traction, MRR and all that good stuff. So it's a huge vote of confidence that they're going to be putting money into the company. He also mentioned he'd be happy to talk to anybody as it relates. This round is $1.5 million at a $5 million pre-money valuation. Our first round was $250,000 at a $2 million valuation. I deployed almost all of that capital with Vayner. Well worth the money. I had 6 people on my team. Market segmentation work, competitive analysis, and all the infrastructure that we previously discussed. That's it, folks. I'm happy to open it up to questions. Oh, well, actually, we could talk exits, too. I thought I was going to get cut off. But the exits... You can't even describe the number of exits, right? It could be a competitor, it could be a private equity group. What I like is the metric. Swerve Sweetener was purchased by Whipstitch, a private equity group out of New England, for 14.8x EBITDA. So if you look at our EBITDA numbers in year 5, it's 80 million EBITDA and 212 million in revenue. That's a $1.1 billion acquisition with a good comp for a multiple. So it's a very compelling and interesting environment to be engaging in right now.
Awesome. All right, let's get into some questions. Again, G starting us.
Well, thank you for your presentation. Wow, I hope we solve all these obesity problems. So tell me more about, what plant grows Jaca sugar and how do you get it? And what kind of pricing are we talking about?
It's a great question. So it was first discovered in the 1970s in jackfruit, kiwi, and figs. The problem is it's such a rare and delicate sugar that it couldn't be extracted without polluting it or destroying it, right? So enter enzymes, technology takes over. You can take the rust off an aircraft carrier anchor with enzymes, enter enzymes, and now you can extract psychose from any fructose. So obviously corn has fructose in it as well. So you literally can now get this extracted economically where you can monetize it and you can build products with it and actually meet a price point that the consumer will tolerate. So our cost of goods sold is 0.459 cents per ounce for the 16-ounce pouch and 0.449 cents per ounce for the 24-ounce pouch. The products, as you can expect, are going to have much higher margins. I would be remiss, though, if I tried to call those out today because we're still in the final throes of recipe formulation. It's going to retail at about $1 an ounce. So that threads the needle between stevia at about 82 cents an ounce and monk fruit at $1.25 an ounce. So if you look at Mintel and you look at some of these other studies out there, 81% of consumers nowadays are paying more for products. They're paying up to get a better product. So we think by making it thread the needle between those two, we've got a decent space.
Great. Quick follow-up. So how many jackfruits do we need to get an ounce of the Jaca sugar?
That's the beauty of it, right? So if I had to build a company where I was subject to the jackfruit population, I'd still be a real estate developer in Nashville. Because just no way. I mean, you've got, forget building a company where you're counting on the weather. There's just too much can go wrong. So the fact now that it can be extracted from any fructose, corn, any fruit has fructose in it. So really it's just a function of the quality of the manufacturing process and drawing it from the raw materials. And I'd have to get you some numbers depending upon the raw material that the manufacturer is using in order to provide you with those specific figures.
So then your extraction process, is that your own proprietary? Is it IP'd or how do you protect your...
It's a great question. Because according to IFIC, less than 15% of Americans have ever heard of this sugar, we made the decision to start out bringing it into this country basically as an importer because we've got an opportunity to build the brand. I can be building the Jaca brand over the next 2 years, establishing myself as the thought leader with these lifestyle modules, establishing myself as the dominant brand. But we are currently doing site selection to build our own manufacturing facility as well so that we can command the whole supply chain. So we're looking at spots in Sacramento. There'll be manufacturing IP associated, but what I didn't want to do, being a real estate developer, I know this all too well, I didn't want to wait 2 years to build that plant to then introduce the sugar because I would have forfeited the opportunity. So basically that's going to come up through the middle, meet 18 months, 2 years from now, afterburner effect, cost of goods sold through the floor. Mm-hmm.
What is the barrier to entry for this market and this product?
It's really hard to say. I mean, the barrier to entry really, anybody with any money can enter any market, right? If I decided to build an electric car tomorrow and I had a ton of cash, I could do it. If I wanted to introduce a new tequila, I could do it. Bottle of water, I could do it. So really, anybody that's got the money and the wherewithal could do it. But I will share that we've been developing this model over about a year and a half. It took me 6 months to vet the supply chain. We evaluated 30 plus suppliers throughout Asia, Southeast Asia, and Europe, DQ'd 26 of them. Look and feel, mouthy feel, taste, color, molecular analysis across the spec sheet to make sure that it was what it said it was. 26 out of 30 went. We landed on 4. So I've got 4 supplier agreements on 3 different continents, which ensures redundancy at the highest level in the supply chain in order to bring this in. As well, we're developing, as I mentioned, these lifestyle modules because consumers nowadays want value add. They want to be finding something compelling behind the company that they're procuring product from, behind the owners of the company that they're procuring product from. They want to be learning something. It took us nearly a year to develop the modules that I talk about. So we consider that to be, a pretty moaty aspect of the business. As well, the voucher program is patentable. It's a derivative of a patent that I co-authored in the 90s in tech, a 700-page patent. That's probably the moatiest out of everything in the model. Am I talking too fast?
Just what she's thinking. So so our integrated supply chain is a risk, but also a benefit for cost and security. But also investors like a founder and a CEO that really has tenacity, because we know that you're going to bite into this and not let go. We can't shake you loose of this. So that's what we want to see. So really, really interesting idea. It's a challenging market to unseat or to bite into these other manufactured sweeteners, but it's a great product and a great idea.
Yeah, it's an interesting market for sure. If it wasn't for the internet, I'd still be a real estate developer. I was printing money in Nashville. I'm in my 50s, but daughter's going off to college. I had zero reason to jump into the sugar business. So I did a lot of analysis up front.
Just out of curiosity, you mentioned that this product is available in Japan. How is it doing there?
Absolutely crushing it. To give you an axiom, Japan, the country of Japan, is spending hundreds of millions of dollars building manufacturing facilities for this sugar, not for export, only for use inside the country. So literally, it's something that they embraced long ago. They call it rare sugar over there. It's that simple. It's something they embraced long ago, and it's in virtually all their foods, like stevia is here.
Thanks so much.
Thanks, folks.
Thank you so much, Pete. Great job. Next, we're going to bring up Luca. Scott. Again, apologies for the technical difficulties. We're having obviously some issues. One of our programs crashed, so we're working around that.
All right, well, thank you. I have a really tough gig here after going. You're saving lives over here, and he's gonna solve obesity problems around the world. And but I will say that I'm also solving a really big problem that's going to impact millions of people. And I'd like to introduce you to Luca. This is the first AI-powered reading app that uses the power of AI and speech recognition to help struggling readers learn how to read. Next slide, please. The impact is huge. We know that the impacts of COVID have been, the residual effects of COVID have been pretty significant. But what most people don't realize is 2 in 5 kids, that's about 28 million kids just in the U.S., can't read at grade level. And we talk about kids with dyslexia. It's very underdiagnosed. 1 in 5 kids that are in school today have some form of dyslexia. And 80% of those kids are undiagnosed. So what does that mean? That means they're not getting the proper academic support that they need while they're in school. So they drop through the cracks. So the impacts are huge across their life. They don't graduate high school. You know, there's a lot of, we could talk a lot about what happens, but the impacts on parents, families, and teachers are huge. And I am one of those parents, okay? My son, Luca, has dyslexia. So that's kind of how I've got to this point. So I've experienced what these people are going through. Next slide, please. So like I mentioned, we have built the first AI-powered reading tutor. using the power of speech recognition. It's really, really important. It's the hardest part of the technology that we built, and AI to deliver custom content with targeted interventions that are designed to drive engagement and inspire confidence in these students. Next slide, please. We have developed, I've worked with CMU for the last 3 years to build a proprietary, 3 proprietary modules, and we've won some awards recently, including we're the semifinalists at the South by Southwest EdTech Conference, which is next month, and we are semifinalists for one of the top innovators there. So we have 3 core modules. Our first is our speech recognition technology, which I mentioned is really hard. We're doing phonetic level recognition. What does that mean? That is the actual individual sounds of the word. So I think someone else mentioned to me earlier that, I think Pete, you mentioned that you had a friend that's doing some work at Amazon. They're doing word level recognition. I'm sure they probably are doing some phonetic level, but this part is extremely difficult, especially when we're dealing with kids that have speech impediments, that talk with their hands here or talk real quiet, or it's hard to articulate sounds. We want to identify the sounds, and then what we do is we actually feed that information into our AI, machine learning, deep learning modules. That this is how we can scale the platform that can actually build custom reading plans for these students. And then what we do is we feed them into our Story Labs component, which is generating this dynamic content for these students. So next slide, please. So this is a great visual for you to understand what we're doing. On the left here, you'll see I asked a question to this student. I said, hey, if you had any favorite superhero powers, what would it be? And he said, I want to do teleportation. I said, wow, that's pretty cool for a 9-year-old. I said, what are you going to do with that? He said, I want to travel the world. I said, okay, well, here's what we're going to do. We're going to have you read some stories. We're going to identify the sounds, those phonetic, those are the grapheme phoneme pairs of the word. And then what we're going to do is we're going to build you a custom story based upon your interests, your reading age, your reading level, and your targeted grapheme phoneme pairs that we integrate into the stories. Okay, so think about that. We've got 5th graders reading at a 1st grade reading level. What are we doing for those kids? We're giving them 1st grade reading materials and saying, go read this story. What do you think they're going to say? I don't want to read that baby book, right? They want to read age-appropriate material at their reading level. And that's how they build their confidence up. So next slide, please. So this is just a quick, I don't think this is this is not the actual deck. This is a PDF, right? Yeah, so I can't show you some screens. I had a little working video here, but this is actually an example of how they would identify their interest. We asked a series of questions. We have, 40, 50 questions that we've established that are all based upon age. So they select that, and they can actually see on the reading screen, which I can't show you right now, but it's 1 sentence at a time. They do not see a whole block of text. They can see one sentence at a time. They can click on a word, and they can actually have it sounded out to them. So if they get stuck on a word, they can, this is designed for them to kind of do at their own pace. They could do it in a classroom, but again, this is something, if they were to read a book at home, they would actually be working with a platform like this. Next slide. In terms of the market, this is an evergreen opportunity. Okay, we have over 1 million kids in the U.S. coming in and having some form of dyslexia. Okay, so these numbers that I have are specifically related to dyslexia only. Okay, so we think this market is much, much larger than what the numbers I have here. But 14 million kids in the U.S. If we're charging on a per student basis, $150 for the year, and from a SAM perspective, we think there's a market penetration that we can get to. That's a subset of that TAM. On a global basis, we're going to talk about that in a minute. There's a really huge opportunity as it relates to the ESL market, and we have a partnership that we're going to be entering into that's going to get us access to this. Can we go to the next slide, please? In terms of traction, we're still early on, even though we're working on this for the last 2.5, 3 years. really have just started with the advent of ChatGPT. So as I mentioned, we've been working with Carnegie Mellon University. We have some pilot programs that we set up with some schools. We're talking to around 40,000. The schools that we're talking to total around 40,000 kids in those schools. And we're working with the Pennsylvania Department of Education right now to try to, feel how we can bring this to that, because they're doing a lot of redoing of their funds, the funding structure in Pennsylvania. So in terms of conferences, I mentioned that we've had some good traction here related to some awards that we won. Our partnership that we're talking about is with Global Expansion Strategies. They're a U.S.-based organization, over 30 years of international work. They just he just messaged me about an hour ago and told me that they got a deal for 300,000 kids in India. And they need they need a literacy component, and they need a math. So they picked us to be their literacy component for their pilot. Next slide, please. In terms of competition, there is not anybody at this point that is doing dynamic content generation and incorporating phonetics and incorporating speech recognition technology. So the other two competitors they're in the space now. Amir's been in there for about 7 years, and they've raised about $10 million. Again, static content, targeted a smaller age. We can target a very large age group. That's what I'm most excited. My son is 17 now, and I say to myself, how do I help kids that have fallen through the cracks? And that is a problem, because these kids are left behind. So there is no opportunity for them to kind of catch up. So, and the last thing that I'll mention that I don't have on the slide that's really important to consider is scalability. Everything is automated. The platform that we've designed is continuously assessing the students, the readers, so that they can identify what their challenges are, and we automatically change their structure. We can increase the complexity of the text, the reading material, the sounds that we're putting into the stories, so we can really grow with the student over a long period of time. Next slide. Great team, as I mentioned. We work with Carnegie Mellon University. We have some neurosurgeons on our team. We have guys that are in the AI school at Carnegie Mellon. Jack has built 2 AI reading tutors over his last 20 years. He's just a phenomenal teacher, as well as some professors that are in the natural language processing school. Next slide, please. In terms of business model, we're a SaaS-based business. Target B2B schools. You guys have talked about some B2C stuff. I'd love to share some of the things that we're doing in that space. I think there's a pretty big opportunity there because of the family need. In terms of, I mentioned about our go-to-market strategy with Global Expansion Strategies. That's targeted $2 to $3 million in booked revenue over the next 12 to 18 months. And in terms of, we just launched a digital ad campaign, and we are already on the first page of Google for 3 terms, which are really hard to get to, but we did that a couple of months ago, and we're doing pretty good there. And last thing on schools is that we're really kind of focused on virtual and charter schools right now, because I think that's really where the opportunity lies for quick adoption versus a public school that might take longer to make those decisions. So next slide, please. We'll talk about investment next, but we've been in touch with a lot of groups, and everyone is very interested, but they're not interested in taking the lead. So I am here to look for a lead investor. These are some people that have all expressed interest in doing follow-on investments after we find that lead investor. So some of these are the biggest names in the ed tech space. Reach Capital, everyone knows Andreessen Horowitz. Imagination Learning Ventures, that's a public, you need me to go? That's a publisher. We can talk about that separately later. Next slide, please. In terms of where we are in terms of investment opportunity, we're looking to raise $2 million in a post-money safe round right now. We have a 2-tiered structure, $500,000 with a 20% discount with a $4 million cap. And then the second tranche is for the $1.5 million, and at a 15% discount. So looking at 81% margins, this is a really very profitable business once we kind of start hitting scale here. Next slide. That's it. Thank you.
Awesome. Yeah, we have just a few minutes here for questions. Whoever wants to start. Lovely Leanne.
This is a really important product that you're building. I used to be a special education teacher, and so I have a lot of thoughts.
Great.
How is this specifically addressing dyslexia, and have you had this vetted by a dyslexia specialist? Because it seems like a great product for any student that wants to learn how to read.
Yeah, absolutely. That's the beauty, is it really can apply to all readers. It does not need to be specifically for dyslexia. We've assembled 7 different studies, evidence-based research studies, to assemble this product. My focus has always been about dyslexia because of my son. That's sort of the genesis of what we came from. But we're using structured literacy in the platform. Our team just met this morning with the dyslexia team at a local university. And one of the people in our advisory group, she runs a dyslexia-focused school. So she's very familiar with all the different ways of approaching dyslexia. I just finished meeting last week with the Pennsylvania International Dyslexia Association, the head of that. And so we think there's opportunities not only in dyslexia, but beyond that. And we're incorporating different things because as a teacher, you'll know there's the thing called reading wars. And everyone has their opinion about what's... the goal here is about driving engagement, and if we can do some things and add different components in that'll touch on different areas, I think we can be successful with that.
And what kind of training needs to be done for teachers to use this in classrooms? If your target is schools, a lot of where I see ed tech fall apart is when teachers don't know how to utilize the tool, and then it becomes this great tool that no one knows how to use.
Yeah, it's first off, it's a scalability factor. So I think that there is some challenge with this in school because you have to read out loud, okay? So we can't have a room of 30 kids all reading out loud. So if we work in small groups, we have some ideas around kind of doing small group reading. If you had to read one-on-one to the class, we have an idea of how we could actually set that up to generate your reading material that you're going to read to the story that's, again, to your interest reading level, and that you could be confident in reading in front of the class. So as opposed to, hey, read this, and everyone's like, you're not that, you're really struggling with this, and you're embarrassed. It's a problem. It's my son. So.
Great questions, by the way. Any more? Really good.
Yeah.
I was just going to take a different tack and compliment you that I know what you're doing on slide 1. And so I just have an absolute rule that if I don't know what you're doing by slide 3, I'm just out of it.
Yeah.
And so you have different firms that are receiving 100, 200, 300 pitches a week.
Yeah.
And they want to tranche you into something that they know and something that they're good at. And if you don't hit that tranche and they're trying to figure it out on slide 6, it just doesn't work. So that was really great that you did that. Great. Just also congratulations on South by Southwest. We've just agreed to do a mini Lions Den at South by on Sunday with the worship track. So it's something that we'll see you there. This is great.
Sunday.
It's the Sunday of the South by Southwest.
Okay, we'll talk after. I just
Yeah, that's great.
Okay.
Nice job.
Thanks.
So I think it's a great product, and I might want to use it myself. It's for fun. Now, it's so it sounds like the components that what differentiates your product is that it's the AI. It generates the content that students love, and then you help them with some of the phonemes and stuff like that. Now, tell me in terms of how hard is it for somebody else to catch up and try to develop something kind of similar? Well, it's a huge market. You certainly can get a big piece of it, but I'm just curious, what would, how do you evaluate that kind of?
Yeah, so we're patent pending, number one. Okay, so we did file some patents, initially, and I have to close that out here coming up in the next 3 months. But the angle of having Carnegie Mellon behind us and that knowledge of speech recognition and what we're doing, like we're actually we're reinventing our speech recognition right now with 7 students, all master level students. So we're going to take like our speech recognition from here to here. I think it's just going to be really hard for people to, knowing the products that are out there, to bring that component in and create the anybody can create a story in ChatGPT. But bringing in that speech level recognition, that's a whole nother component that I've not seen out there. And, you know, can someone do it? For sure. I mean, I'm sure someone's going to probably listen to me and want to steal the idea right now. But no, I think if we get ahead of the market, that's really the focus. That's why I want to go after this international opportunity in the ESL market and just start getting like, you know, 1 million users, 2 million users overseas. And we would actually look to go right to publishers in the U.S. because that's the distribution market in the U.S. Is you go to publishers that are already entrenched in the school districts, they'll want to just roll it out. One of those partners I mentioned was up there. They've already talked to us and would be like to make an investment, but then they'd be looking to put that into their publishing network in the school. So
Carnegie Mellon is helping you to improve the speech recognition. How much, like, do you pay them a license fee, or how does it work in terms of the relationship?
No, it's a little bit complicated. It's really not that complicated. We're doing a capstone program with them. So I pay to actually engage these students. We've had the highest demand out of all of the capstone programs. Companies bring problems to them, to CMU. CMU helps those companies solve those problems. And students get to select which projects they want to do as part of their senior. This is their master level students in AI and innovation. So this is their like thesis. And so they really get into it. So we have 7 kids. We've had the most out of any other groups. And I compete against like Bank of New York, Mellon. I mean, we have some really big companies, and the kids always want to come and work with us because of the social impact of what we're doing. So we don't have any, there's no baggage or, I think, licensing fees that we have to pay or IP. We own the IP, and that's pretty cool.
Great, thank you.
Thank you.
Great job, Scott. Thank you. Yeah, last we have Sajol from Advanced Telesensors. After this, we will be sharing the slides. I know he didn't get to show the video off, but we will be sharing those with everybody, so you'll have all of that after in your follow-up. All right, take it away.
So it's been the last couple of presenters have sort of shared some pretty dramatic cardiovascular issues. So I wanted to start with the slide and ask you to think about your family or friends, people that you know, and raise your hand if you know someone who's had a heart attack or at risk of heart failure. Okay. So that's what I want to talk about to cover. Next slide. So I'm Sajol Ghoshal, CEO of Advanced Telesensors. What we are doing is, the problem we're solving is reducing hospital readmissions of heart patients that cost insurers billions of dollars, and many lives are lost. The answer is a heart monitor that's always on and can remotely alert your nurses or doctors of any abnormal heart rhythms so that these cardiac activities can be prevented. Put yourself in the position of a cardiologist who from time to time loses patients or needs to send them to critical care. What he wants is a way to remotely monitor his patients and get early warnings on cardiac events so that he can adjust his treatment, thus saving lives and reducing penalties from Medicare due to readmissions. So we have a revolutionary way of doing this. It was developed at NASA. It's a touchless heart monitor that doesn't use any wearables. It detects micro vibrations of your heart using radar and sends critical alerts so that treatment can be adjusted in time. So why am I so excited about this team? I've known Frank for over 20 years. I trust him. He's our COO and CFO. Dr. Jason Zagrosvi is our Chief Medical Officer and a heart rhythm specialist. The rest of the team have all the skills necessary to bring this product to market. I'm a serial executive with 3 successful exits totaling $3 billion. So why am I so passionate about this business? My father passed away at a young age of 51, and it had a huge impact on me. I realized I made a mistake focusing on engineering alone. So now I'm making up for lost time and focusing on healthcare, and I need your help. So what is so compelling about this product that our customers want? By law, Medicare requires at least 16 days of monitoring data out of 30. We are the keystone to Medicare reimbursements because we enable automatic data gathering of our patients without them doing anything or wearing anything. This is not doable with wearables. So how big is this market? We have strategically focused the company on the skilled nursing market, our beachhead market of $1.5 billion, which is part of the $31 billion remote patient monitoring market that's growing quite rapidly. So who are our customers? Our customers are patient care integrators who already have established customers. This makes our customer acquisition cost very low. So cardio enables the entire RPM package to be reimbursed by our integrators. So how do we make money? We sell the hardware and we license the software on a monthly basis. So how do we know that the market really wants our product? So we are designed and deployed in 3 nursing homes. And we have started clinical studies with University of Texas in San Antonio and the Texas Cardiac Arrhythmia. Our patient care integrators have access to over 200,000 beds. And we are making revenue right now from Medicare reimbursements. So why is this an exciting opportunity for you? Our 5-year projections are $102 million with high profit margins. And we will be profitable after 2 small rounds of funding. This minimizes investor dilution and gives us a great exit. So here are some recent acquisitions of companies that have cardiac monitors by very large medical companies. Our technology will be more of a strategic acquisition, may not necessarily be multiples of sales, and may be in the short term. So we are raising a bridge loan. It's a convertible note for $2.5 million, and we've raised $500,000 to date so that we can achieve our FDA class device and have an ARR of $1 million. The cap on the note is $10 million. Thank you for your time.
Awesome. Great job. Let's move it over to the panel. Who is ready? Sure.
Thanks for the presentation. So how does the touchless monitoring work again?
So it's a radar. You mount it on the wall. It's a small device. You mount it on the wall. When you enter the room within 10 feet of the device, you will pick up your heart rate and respiratory rate continuously. And if we see any bradycardia, tachycardia events, we'll send an alert.
Gotcha. And so if the patients kind of travel around, you kind of bring it with you?
Yeah, so normal movement we track. Obviously, we cannot be in a gym. That's one of the big markets that would be very interesting. But your regular repetitive movement will not be, will affect your heart rate detection.
Sure. So what do you need to get it approved?
So we have already gone through the FDA. We've had 3 meetings with the FDA. And they've raised the bar. That's one of the 3 meetings have occurred. But we've got the pre-submission approved. And so now it's a matter of $750,000 that we need off that $2 million we're raising that'll drive the validation and clinical trial.
Do you need to do any clinical trials?
Yeah, FDA now wants our previous Predicate device didn't do it, but they want us to do it. So we have to do 3 sites with 30 people each, which is 90 people in the plan.
Thank you.
So it's non-invasive, so I'm assuming the trials are pretty minimal.
The trials are pretty minimal, yeah. It's just a matter of getting the demographics right.
And then how far does the radar reach? So your example of in the bedroom, great, understand that usage model.
Right.
What about for the person in the assisted living facility or even the not assisted living facility?
Right. So for assisted living, we find that most of the rooms are within that 10 by 10 foot area or 12, and we can pick up the person within that room. We didn't want to go past 10 because we didn't want to pick up people on the corridor walking through. So if you need more coverage, like right now we have got 2 pilots going with PAM Health. We've got our unit in the bedroom and 1 in the living room. Because when people who have commodities, they don't move around a whole lot. So they're in the bedroom and then they're in the living room for the next 8 hours watching TV. And we can get good coverage from that from both sides.
Creative idea. I love the cross-industry utilization of technology. This is definitely something I'd like to talk about.
Thanks.
So it sounds like your target customer is the nursing home, kind of.
Right.
Okay. Can it only detect one person?
Yes. Right now we are a single target detector. As we grow the company, we can do multi-targets. Radar allows you to do multi-targeting. It's just a matter of changing the software.
And how does that work? Like, does the person that's being detected have to wear some type of device?
Nope, absolutely nothing. So your heart pounds and we pick up the vibration from the surface of your body. It's very minute. And so a lot of it is the AI and machine learning algorithm that were developed by NASA to put that in place.
So if there are 2 people in the room, what happens?
If there are 2 people in the room, we get a mixed signal, and so we don't pick it up. If you look at the way we actually mount the device, we came up with a very simple way to mount because deployment was very, very important. So it mounts on the wall. It's got about a 45-degree angle, and so it picks up the person right on the bed. So you can have a nurse or caregiver on the side. It will not necessarily pick them up. If they put their head in under the beam, yes, they're going to get picked up. Okay, but it's unlikely. If it does happen, obviously the person's in trouble.
And you collect the data. So is there any kind of policy that needs to be implemented to make sure the data is safe?
Yeah, so we are connected through a HIPAA-compliant cloud. It's one of the other companies we work with, so we outsource the cloud. And so they are fully HIPAA-compliant, and then we connect it to apps or to a browser that you can connect to. Most of our customers, though, connect directly to our API, and they are actually putting the rest of the information together. So they build the next level of AI around it, where they integrate more information and provide a more comprehensive view to cardiologists.
No, that's really good questions and good presentation. Is there a discount if we buy one today, or what do you think?
Yeah, absolutely. We got a 20% discount on the web. So we've been selling on the web for the past year. We just got engaged with the integrators. The best part of the integrators is they carry water, so I don't have to build the hardware. They actually take that over. So we've now made it that's one of the reasons the customer acquisition costs are really much lower.
Great. We actually do have another minute. If anybody in the audience has an additional question, happy to get that answered for you now. All right. Well, then thank you so much, Sajol. Great job. All right, awesome. Yeah, that was our last presentation, but we do have happy hour food and alcohol over in that corner, so please, we encourage you to indulge as much as you want. Please give one more round of applause to our amazing presentations and founders today, and keep it going for our judges on the panel who asked amazing questions as well. Get to know our founders during our networking portion. We'll be here for about another hour. And yeah, if you have any questions about 10, there are plenty of our team members around as well to answer those. Thank you again, guys, and yeah, enjoy.